Are you thinking about jumping into the world of investing but worried about making costly mistakes? You're not alone. New investors often fall into the same traps that can lead to significant losses. But what if you could avoid these pitfalls and set yourself up for success right from the start? In this video, we're going to break down the top 5 mistakes that new investors make and, more importantly, how you can avoid them. Stick around, and let's make sure your investment journey is off to a solid start. Number 1. Failing to do proper research. One of the biggest mistakes new investors make is diving into investments without thorough research. You might come across a stock that's generating buzz or see a flashy ad promising quick returns and feel tempted to invest immediately. However, this approach is risky. Investing without understanding the underlying asset is like setting sail without a map. When you fail to research, you're essentially betting on luck rather than making informed decisions. This can lead to investing in companies with poor fundamentals or industries that are about to face a downturn. For instance, if you invest in a tech startup without knowing its revenue trends or its competitive landscape, you might find out too late that the company is struggling or facing significant risks. To avoid this pitfall, start by analyzing the company's financial health. Look at key metrics such as revenue, profit margins, and debt levels. Understand the company's business model and its position in the market. Are there any red flags, like declining sales or high levels of debt? Additionally, consider the overall market conditions and industry trends. Diversifying your investments can also help mitigate risks. Instead of putting all your money into one stock or sector, spread it across different assets to reduce the impact of any single investment's poor performance. Research might seem time-consuming, but it's crucial for making sound investment decisions and protecting your financial future. Number 2. Letting emotions drive decisions. Investing can be an emotional journey. One day the market is soaring, and you feel like a financial genius. The next, it's crashing, and you're gripped by fear. Many new investors make the mistake of letting their emotions dictate their investment decisions, which can lead to costly errors. Emotional investing often results in buying high and selling low, exactly the opposite of what you should be doing. For example, if you see your investments declining, panic might lead you to sell off your holdings hastily, locking in losses. Conversely, when a stock price is rapidly increasing, you might feel the urge to buy in, only to find out later that you've purchased at a peak, and the price drops soon after. This kind of behavior can be detrimental to your investment success. Emotional reactions can cause you to make decisions based on short-term market fluctuations rather than long-term fundamentals. For instance, during market downturns, investors who act on fear might sell their shares and miss out on subsequent rebounds. During market booms, investors driven by greed might chase trends, potentially buying into overvalued stocks. To avoid making decisions driven by emotions, it's important to have a well-defined investment plan. Start by setting clear goals and determine your risk tolerance. Stick to your plan even when the market gets turbulent. Using strategies like dollar-cost averaging, where you invest a fixed amount at regular intervals, can also help reduce the impact of market volatility on your investments. By maintaining discipline and focusing on your long-term objectives, you'll be better equipped to navigate the ups and downs of investing without being swayed by emotions. Number 3. Trying to time the market. Another common mistake new investors make is trying to time the market. The idea is to buy low and sell high, but in reality, predicting the perfect moment to enter or exit the market is incredibly difficult, even for seasoned investors. The stock market is unpredictable, influenced by countless factors including economic data, political events, and market sentiment. Many new investors attempt to capitalize on short-term market fluctuations, hoping to maximize their returns by timing their trades perfectly. This approach can lead to buying at market peaks and selling at lows, often driven by emotions rather than logic. For example, if you panic and sell your investments when the market dips, you might miss out on a subsequent rebound. Conversely, if you rush to buy when prices are high, you might end up with losses when the market corrects. Instead of trying to time the market, focus on staying invested over the long term. Historical data shows that the stock market tends to grow over time despite short-term volatility. By maintaining a long-term perspective and sticking to your investment strategy, you can benefit from the overall upward trend of the market. Regularly invest a fixed amount regardless of market conditions, known as dollar-cost averaging, which can help smooth out the effects of market volatility and reduce the impact of timing mistakes. Number 4. Ignoring fees and costs. When starting out, it's easy to overlook the fees and costs associated with investing, but these can have a significant impact on your returns. Many new investors focus on the potential gains and ignore the hidden costs, which can erode their profits over time. Investment fees come in various forms, including management fees, trading commissions, and advisory fees. Management fees are typically charged by mutual funds or exchange-traded funds, ETFs, and can be expressed as an expense ratio. Even small percentages, like 1%, may not seem significant at first glance, but they add up over the long term. For instance, a 1% fee on a $10,000 investment might not sound like much, but over 30 years, it can significantly reduce your final returns. Trading commissions and advisory fees are additional costs to consider. Frequent trading can lead to high commission fees, which can erode your profits, especially if the trades don't yield significant gains. If you work with a financial advisor, it's important to understand how they're compensated. Some advisors charge a flat fee, while others earn commissions based on the products they sell. This can influence their recommendations and potentially increase your costs. To minimize the impact of fees, consider investing in low-cost index funds or ETFs. These options typically have lower expense ratios compared to actively managed funds. Also, be mindful of transaction fees and try to minimize frequent trading. When working with financial advisors, seek out those who are transparent about their fees and offer services that align with your investment goals. Number 5. Not having a clear investment strategy. Jumping into the world of investing without a clear strategy is like embarking on a road trip without a map. You might have a general destination in mind, but without a detailed plan, you're likely to encounter unexpected detours and obstacles. A lack of strategy often leads to inconsistent decision-making. For example, you might invest in a popular stock or follow a tip from a friend without considering how it fits into your overall financial goals. This scattershot approach can result in missed opportunities and unnecessary risks, ultimately hurting your investment returns. To avoid this mistake, it's crucial to develop a clear investment strategy aligned with your financial goals. Start by defining your objectives, whether you're saving for retirement, a major purchase, or another goal. Next, determine your risk tolerance and investment horizon. For long-term goals, you might be comfortable with higher-risk investments that offer greater potential returns. For shorter-term goals, a more conservative approach might be appropriate. Create a diversified portfolio that reflects your strategy and stick to it. Regularly review your investments to ensure they remain in line with your goals and adjust as needed. Having a well-defined strategy helps you stay focused, make informed decisions, and navigate the ups and downs of the market with confidence. Investing is a powerful tool for building wealth, but it's important to avoid these common mistakes to ensure your journey is a successful one. Remember, investing is a marathon, not a sprint. By avoiding these mistakes, you can set yourself up for long-term success. If you found this video helpful, don't forget to hit the like button and subscribe to our channel for more tips on how to make smart investment decisions. Thanks for watching and happy investing.